For decades, UAE Freezone entities operated under a blanket corporate tax exemption. Federal Decree Law No. 47 of 2022 removes that automatic status. This legislation introduces a dual rate system. Entities either qualify for a 0% rate or their revenue defaults to the standard 9% tax. Tax liability is now calculated at the individual transaction level. Managing this requires applying the QFZP algorithm, a process for separating every dirham of revenue into the 0 or 9% bin. This framework is built on Cabinet Decision No. 100 and Ministerial Decision No. 265. These texts define the specific routing rules. To access the 0% bin, an entity must achieve and maintain Qualifying Free Zone Person, or QFZP, status. Under this regime, tax status is algorithmically determined for every individual transaction. The algorithm starts with Article 18. The entity must be a registered juridical person inside a designated UAE free zone. Natural persons, including sole proprietors, do not qualify for QFZP status. The entity must also maintain adequate substance within the UAE. This requires performing core income-generating activities locally with an adequate number of employees and physical assets. Companies must also prepare audited financial statements and follow the arm's length principle for all transfer pricing. Failing any of these baseline Article 18 conditions at any point in the year has immediate consequences. The entity loses its QFZP status for the current tax period and for the 4 subsequent tax periods. There is a specific allowance for companies in the startup phase. If they are not yet generating qualifying income, they are not automatically disqualified. Article 18 compliance is a mandatory prerequisite. If these conditions are not met, the algorithm defaults all revenue to the standard 9% rate. Once the entity clears the baseline, the algorithm analyzes individual revenue streams based on the counterparty's identity. Path A handles transactions between 2 free zone entities. This path qualifies for the 0% rate only if it passes the beneficial recipient test. The recipient must be the one that uses and enjoys the good or service. If they have a legal or contractual obligation to pass that item to another person, they are not the beneficial recipient. Sellers must maintain written statements or contracts to prove their free zone counterparty is the actual beneficial recipient. Path B covers transactions with non-free zone persons, which include mainland UAE businesses and international clients. Revenue from these counterparties only qualifies for the 0% rate if it is derived from a statutory qualifying activity. Entities must account for domestic permanent establishments. A mainland branch of a free zone company is taxed at 9% on its own attributable income. Counterparty identity dictates the compliance burden. You must prove ultimate consumption for other free zone persons or verify the activity type for everyone else. Ministerial Decision No. 265 lists 13 statutory qualifying activities. Any revenue from a non-free zone person that falls outside this list defaults to 9%. Manufacturing and processing activities are covered, including component assembly and product improvements. Simple repairs, however, do not qualify. Distributing goods or materials qualifies if they enter the state through a designated zone. High sea sales and third port shipments can also meet this criteria. Commodity trading is limited to metals, minerals, energy, and agricultural products in their raw form, traded on a recognized exchange. Ancillary activities also qualify if they are minor and necessary for the performance of a main qualifying activity. The algorithm then filters for excluded activities. If a transaction hits this filter, the revenue is automatically routed to the 9% bin. This filter catches banking, most insurance activities, and transactions with natural persons. The law provides specific exceptions to these exclusions. Fund management, wealth management, and aircraft leasing are allowed to transact with natural persons while retaining the 0% rate. The statutory nature of an activity is a primary determinant. Engaging in an excluded activity redirects that specific revenue stream to the standard tax rate. Because a single non-qualifying transaction could jeopardize an entire entity's tax status, the law provides a margin for error. This is the de minimis rule. It acts as a safety harbor for small amounts of non-qualifying revenue. To stay within the safe harbor, non-qualifying revenue must not exceed 5% of total revenue, or 5 million dirhams, whichever is lower. Certain revenues are removed from this calculation entirely, such as income from mainland immovable property. While property income is taxed at 9%, it does not count toward the 5% threshold that could disqualify the entire entity. The algorithm uses a separate, specialized node for intellectual property income. Qualifying intellectual property includes patents and copyrighted software. Marketing assets, such as trademarks and brand names, are strictly excluded and taxed at 9%. Qualifying income for IP is calculated by taking qualifying R&D expenditures, adding a 30% uplift, and dividing that by overall IP expenditures. The tax framework accommodates minor operational deviations and specialized R&D, provided the entity actively monitors these rigid mathematical caps. This is the completed QFZP flowchart. It is a comprehensive grid of substance requirements, counterparty rules, and activity filters. Each revenue stream must navigate this process, passing the counterparty gate, surviving the activity check, and staying within mathematical limits to reach the 0% bin. Substance requirements and the beneficial recipient test mandate that companies maintain physical and economic reality to qualify. Compliance requires active transaction monitoring and precise expense allocation by corporate controllers. Ultimately, successfully accessing the 0% corporate tax rate requires an active, continuous demonstration of strict algorithmic compliance.